Hi, this is Charlie giving you Wednesday's video. I'm recording it on Tuesday evening as usual. So, are we seeing a collapse in volatility across Forex? So, the easy way to measure whether volatility is reducing or increasing is just to put an average true range indicator on your chart. So that's what I've done here. So I've got a chart of the euro dollar here to start off with. And I've got an ATR, average true range, here, just a standard sort of 14 period setting on it. Now, the nice thing you can do about this, rather than you can look at implied volatilities in the options markets on Forex as well, and to get an idea of implied volatility going forwards and whether market expectations are for increase or decrease in volatility. But this, for the most retail traders, is the easiest way to do it, and just to say, okay, where are we at? So if we look at the euro dollar, we can see that this year the ATR is gradually coming down. We were down a 47 pip daily range, not 474. That's a pipette there. That's a fraction of a pip. So 47 pip daily range. The last time we were down this low, if I just press pause and scroll back, so the last time we were down this low was back in August of 2014, when it really got down to about 40 pips. So we're not that far off of the lows from 2014. If I take you out to a monthly chart, it gives you an average, so you can see that low there. But this is an average on the month, or on a monthly chart here. Sorry. So that's why it shows as being higher there. So certainly what we can see is on a monthly chart, we are the lowest we've been since back in 2006, 2007 on the euro dollar. So does that mean that currency volatility is going to continue to diminish? No, we can I can pretty much pick any currency pair, and we can generally see a general trend, not necessarily exactly like the euro, but even the pound here declining over the last couple of years. Let's go to the dollar yen. That's been declining over the last couple of years. They're not, their ranges aren't quite as low as the euro. Aussie dollar on the decline, as you can see as well. So, and let's go to dollar CAD. Again, over the last couple of years, we've got a decline. So, generally speaking, in the major currency pairs, we're seeing a decline in their overall volatility, i.e. a decline in their average ranges. So the lower the ranges, the lower the volatility, which means there's not as much movement. They do move, of course, but there's not as much as there might have been back in this example, back in 2016 and 2017. We've got a lower monthly range here on dollar CAD than we had back there. But all is not lost. Does it mean that they're going to carry on and they're going to collapse lower, in which case the volatility in these currencies is going to be so low that it makes them not worth trading, so to speak? Well, if we go back to the euro dollar to start off with, what actually is happening on the euro dollar is it's been winding itself up within this multi-year pattern. So you can see this pattern. If I zoom out a little bit more, you can see this wonderful multi-year pattern that we've been building on this triangle pattern over decades actually, since it started, the lower trend line, and certainly over the last decade. We can see it's been building. So what's actually happening here is the euro dollar, if I just zoom back in a little bit again, get it about right, there we do, that'll do. So it's winding itself up right into the pinnacle of this triangle pattern here. So I'm actually quite bullish on volatility going forward over the next few years. I'm not talking about necessarily right now, next week, next month, because that's a lot harder to predict when exactly it's going to pick up. But certainly a time is running out, and when we get a break, I suspect, whether it breaks to the downside or upside, whatever, we're going to see a pickup in ranges, because the market will stretch its legs, which means more participants will come in, and so we will get that pickup in volatility. So it's quite nice to know. And the reason I come back to the euro dollar is because the euro dollar is the most widely traded currency pair, the highest volume, and so why it's useful as a barometer here for what would, and that would affect the other markets as well, because if there's more euro dollar trading going on, then it affects all other markets as well. So I suspect we're going to see at some point a breakout of this overall pattern here, and then that's where we'll see the volatility pick up. Anyway, but as I was saying, all is not lost anyway, even if this was to continue to get smaller and smaller, wind itself up within that pattern. There are other markets whereby volatility's picked up. So if we take the S&P here, so I've got a monthly chart now of the S&P, and we can see that actually the S&P is at all-time highs in volatility, way higher than what we had back in, as far as range is concerned anyway. Speed of price action might be a little bit different, but as far as range is concerned, it's got bigger ranges now than it had back in during the financial crisis. And that means that these stock market indices, whether it's the S&P, the DAX, the FTSE, whatever it is you're trading, they've all got decent enough ranges there. So that's very much a positive. So as traders, we have to be willing to look at different markets. And the one thing that you have to be very careful of as being a retail trader is not just chasing volatility all of the time, because then you're just here, there, and everywhere. But certainly including a couple of extra markets into your overall analysis can be really quite useful. So whether it's something like the S&P there, or something like the yuan. So if we've got bring that up, here we go, is the Chinese yuan. Now that's got a lovely range here. So if I take you out to a weekly chart, you'll see it's in decline over the weeks, but it's got a really nice range. So that may be a bit rich for some people, some traders, because it has got quite a high daily range of 305 pips, which is quite a high daily range. But certainly worthwhile looking at some cross pairs as well. But I've been looking at cross pairs, and you can still go to the likes of, I don't know, let's pick pound yen for example. We're still seeing cross pairs having a decline. If I go to monthly chart, there you go, in their overall volatility. But some pairs have bigger ranges than others. So if you're looking at something like the euro dollar, which has a daily range of 47 pips, that's fine, still the highest volume traded market. But if you have a trading style that requires a bigger range than that, then do have a look at other major currency pairs, major crosses, and some stock indices and the likes as well. So there is always movement. That's what my point is. There's always movement out there, but well worthwhile having a look around. But certainly, as far as I'm concerned, using that euro dollar as a barometer, at some point there will be a lot of volatility coming in. It wouldn't surprise me in the next year that the average range of the euro dollar doubles from where it's at right now. So anyway, useful stuff. Always worthwhile looking at this sort of information. I shall leave you to it, and I'll see you on Friday for live trading.